Welcome back to the Trading Desk. This is Talk Tickers, the show where we don't just read the headlines, we rip them open to see what makes the machinery tick.
Exactly.
If you're listening to this, you aren't looking for basic definitions or, a pat on the back. You're looking for alpha. You want to know if the market is mispricing reality.
And today we have a fascinating case study on the desk.
We really do.
It's a classic setup, really. It's one of those scenarios that, it separates the tourists from the locals in the semiconductor space. We are looking at Rambus.
Rambus, ticker symbol RMBS.
That's the one.
Exactly. And let's set the scene here because context is everything. Today is February 15th, 2026. We're looking back at the earnings call that dropped on February 2nd.
Right.
Now, if you just glance at the headline numbers for fiscal year 2025, you'd think champagne corks were popping in Los Altos. I mean, they delivered a record-breaking year.
They did. They beat top-line expectations. On the surface, it looked great.
And yet, if you looked at your screen on February 3rd, you saw a sea of red.
Oh, it was brutal. The stock didn't just dip, it capitulated. It tanked nearly 14% in the immediate aftermath.
From what, about 113 down to the high 90s?
Dropping from around $113 down to, the high 90s. A huge, huge move on what looked like good news.
That is the central tension we are here to resolve today. How does a company print a record year, beat revenue, hit their EPS targets, and then get taken out to the woodshed by the market?
It's the multi-billion-dollar question.
Our mission for this deep dive is simple. We need to figure out if this sell-off is a structural red flag. I mean, is the whole thesis broken, or is this a temporary dislocation caused by a one-time operational glitch?
It's the difference between a falling knife and a discount sale. And to figure that out, we have to strip away the panic and just look at the mechanics of what actually happened in their supply chain.
Because this wasn't a demand problem.
No, not at all. This was a very specific, very weird supply incident.
We're going to get into the weeds of that glitch in a minute because it is a wild story. But first, let's establish the baseline. We need to look at the print. The actual results they posted before the narrative went completely off the rails.
Okay, let's do it.
Walk us through the headline numbers.
So looking at the Q4 and fiscal year 2025 results, the backward-looking numbers were actually, quite solid.
Solid. How so?
Well, non-GAAP earnings per share, that came in at 68 cents.
Okay, 68 cents. And where was the street on that?
Dead in line. It was exactly what the analysts were expecting. Now, it was flat year over year compared to the 58-cent GAAP number, but in terms of what the analysts had penciled in, Rambus hit the target. No miss there.
Okay, so no earnings miss. Check. What about the top line?
Yeah.
Your sales.
Revenue came in at $190.2 million.
And the street was looking for?
A little bit less. They were at $188.1 million. So, it's a beat.
It's a beat. It's a slight beat. About 2.1 million, but a beat is a beat.
Right. And more importantly, that revenue number is up 18% year over year.
18%. Now, that's a real number. That's double-digit growth in a sector that can be, pretty cyclical.
Exactly. It shows real momentum going into the end of the year.
And we always tell our listeners, with a company like Rambus, you have to peel back the layers of revenue. You've got the licensing and royalties, which is sort of the steady paycheck. And then you have the product revenue. That's the growth engine.
Right.
So how did the product side perform?
That was the star of the show, historically speaking. Product revenue hit a record $96.8 million for the quarter.
A record.
A record. And that's up 32% year over year.
32%. Wow.
Yeah. That's the number you want to see moving up and to the right, because that's where the memory interface chips live. That's the whole DDR5 story playing out.
That's the high margin, high growth part of the business. Okay. So record product revenue. Now, before we get to the disaster, we have to acknowledge the balance sheet. In this kind of high interest rate, volatile environment, cash is king. So how does the fortress look?
Oh, it's a fortress, all right. They generated $99.8 million in cash from operations.
Just in the quarter.
Just in Q4.
Yeah.
And their total cash and marketable securities now sit at $761.8 million.
So they have $750 million in dry powder.
Basically, yeah. They are not going bankrupt. They are not in a liquidity crisis. They have a ton of flexibility.
So let's just pause and look at this snapshot for a second. You have record product revenue, 32% growth there. You have beat on the top line. You have a massive cash pile.
Everything looks great on paper.
And yet the stock drops 14%. We have to address the elephant in the room. the market reaction was, I mean, it was violent.
It was visceral, and it tells you everything you need to know about the psychology of the semiconductor market right now.
Which
The market does not care about what you did yesterday. It cares about what you're going to do tomorrow. And Rambus, unfortunately, handed the market a giant box of uncertainty wrapped in a supply chain puzzle.
So it wasn't the Q4 results.
Not at all.
It was the Q1 2026 guidance.
Precisely. The street hates uncertainty, and the guidance for Q1 was, well, it was soft. And the reason it was soft is where this story gets really, really interesting.
Okay, let's unpack this. This is the deep dive into the supply chain glitch. This is the narrative that tanked the stock. Management disclosed a very specific issue that forced them to guide down for Q1. What exactly happened?
It sounds like something out of a manufacturing nightmare, honestly. They had a back-end manufacturing issue with a specific OSAT partner.
OSAT, explain that for a second.
OSAT stands for Outsourced Semiconductor Assembly and Test. These are the companies that take the finished silicon wafers from the fabs and then, cut them up, package them into the final chips you'd recognize, and test them.
So the chips were designed correctly. The silicon itself from the foundry was fine, but the very last step, the packaging process, hit a snag.
Exactly. They identified a quality issue. Now, the CEO, Luc Serafin, was very specific about this on the call. He said it affected a very low number of parts.
What does that mean, very low?
We're talking low ppm parts per million. So out of a million chips, maybe a handful were bad. But the problem was it was incredibly hard to reproduce the failure.
That is the worst kind of bug, the intermittent one, the one you can't easily replicate on a test bench.
Right. If you can't replicate it easily, you can't be 100% sure which parts are bad and which are good without just, testing everything rigorously.
So management had a choice to make.
A tough one. And they made a call. They prioritized quality over shipments. They decided to quarantine all potentially impacted production material.
All of it. That is a massive decision. You were basically freezing your entire inventory flow.
It is. It's a huge step. They decided to rescreen everything with enhanced testing protocols, which takes time and, it gums up the works.
Right. But here's the kicker, and this is the part that explains the financial weirdness between the fourth quarter and the first quarter.
Yeah.
To save Q4, the one they just reported these great numbers for, they pulled a maneuver.
Yeah, they did.
The classic robbing Peter to pay Paul maneuver.
Essentially, they realized they had this quality hold on the current production batch, but they had other inventory, fresh inventory, that was already staged and was intended for Q1 delivery.
I see where this is going.
So to meet the strong customer demand they were seeing in Q4, they pulled that fresh Q1 inventory forward and shipped it out the door in December instead of January.
Which explains why Q4 looked so good. They beat the number because they were shipping 6 or 7 weeks worth of product in a 4-week period, effectively.
Mm-hmm.
They drained the Q1 tank to keep the Q4 engine running.
That's a perfect way to put it. They saved the quarter, they hit the numbers, but that left the cupboard completely bare for Q1.
So they entered the first quarter of 2026 with depleted inventory buffers and a production line that was clogged up at all these quarantine parts undergoing rescreening.
A total logistical hangover.
Talk about a hangover. So they print the record Q4, but then they have to get on the call with analysts and say, hey, by the way, Q1 is going to be light because we already sold you the stuff we were supposed to sell in January.
Exactly. And the CFO, Desmond Lynch, he quantified this hit. He called it a low double-digit million impact.
So $10, $15 million?
Something in that ballpark. So when you look at the guidance, revenue is guided down to a range of 172 to 178 million.
Which is way below where the trend line should be.
It's significantly below. That gap, that missing 10 to $15 million, that is the source of the market's angst.
And in this market, if you miss a beat, you get punished.
Yeah.
The fear isn't just the lost revenue for one quarter, is it? It's the fear that this glitch isn't really just a glitch.
That is always the fear. Is it truly one time? Management insists it is. They were very, very clear on the call. They said the root cause is identified. The corrective actions are in place.
And what's the recovery timeline?
They are expecting a V-shaped recovery in product revenue starting in Q2.
So the narrative they're selling is, look, we had a hiccup, a bad batch. We fixed it. We pulled inventory forward to make you happy in Q4. Q1 is an air pocket, but Q2, we snap right back.
That's the story. They expect inventory replenishment to be completed by the end of Q1. So theoretically, by the time we get to April, the machinery is humming again.
But you have to understand the investor mindset. The big question they're asking is, okay, if you can't ship, did your customer just wait patiently for you? Or did they pick up the phone and buy a chip from a competitor?
That is the key question. In a tight supply market like this, does loyalty exist? Or does necessity drive market share loss?
And management claims no reputational damage, but we will definitely get to that in the risk analysis. For now, I want to pivot to the fundamentals. Because if you strip away this supply chain drama, what is happening with the actual technology, with the core business?
This is where the bull case lives. I mean, if you believe the glitch is temporary, you have to look at the underlying asset. And the underlying asset is their position in DDR5 RCDs.
RCDs, register clock drivers.
Yep.
These are basically the traffic cops of the memory module. They're essential for high-speed servers. What is their market share looking like in that space?
It's impressive. Rambus claims to have exited 2025 with a mid-40s% market share in DDR5 RCDs.
Mid-40s. So for every 10 server memory modules out there using this tech, almost 5 of them have a Rambus chip on them. That is a dominant position in what is essentially a duopoly or an oligopoly market.
It is, and the trajectory is just as important. They were in the early 40s in 2024, so despite all this noise, they're actually growing share in a growing market.
That's a key point. They aren't bleeding out to competitors, they're gaining ground.
Right. They're taking share.
And we are also seeing a generational shift within DDR5 itself, right? It's not just one static product.
Correct. It's constantly evolving. Q4 of 2025, for instance, was dominated by Gen 2 DDR5, but the transition is already happening. Gen 3 is ramping up as we speak.
And what's the expectation for Gen 3?
They expect Gen 3 to become the dominant volume driver in 2026. And every time the generation shifts from Gen 1 to Gen 2 to Gen 3, it kind of resets the ASP, the average selling price dynamic, a little bit, and it requires new qualification from customers.
And Rambus seems to be executing well on those transitions.
Very well. They're leading the charge.
But the story isn't just the RCD anymore. For a long time, Rambus was the RCD company on the product side. Now they're trying to sell the whole combo meal.
Chuckles. That's a good way to put it.
Let's talk about the companionships, specifically the PMICs, the power management ICs.
This is the big diversification play for them. In the DDR4 era, the power management was handled on the motherboard. But with DDR5, the power management moved directly onto the memory module itself, the DIMM.
Which created a brand new socket, a new market for a chip that didn't really exist in the same way before.
Exactly. A new piece of silicon real estate. And Rambus has been trying very hard to attach their PMIC sales to their RCD sales.
So how is that going? Is it actually working? Are customers buying the set?
The data suggests, yes, it's working very well. They moved from being a nice-to-have to a real revenue driver. In the first half of 2025, PMICs were a low single-digit contribution to their product revenue.
Okay, so barely a rounding error.
Almost. But by Q4, they were in the upper single digits.
Wow, that is a fast ramp from, say, 2% to 8 or 9% in 6 months.
A very fast ramp. And the forecast, even with the Q1 mess, is for them to hit a double-digit contribution of total product revenue in Q1 2026.
So over 10% of their chip business will be PMICs next quarter.
Correct. This is significant. It validates the whole strategy. It shows that clients prefer the combo meal, buying the RCD and the PMIC together from one vendor.
Why is that? What's the benefit for the customer?
It gives them interoperability assurance. If the RCD, the brain, and the PMIC, the heart, are designed and tuned to work together, it reduces the risk of system failures, validation headaches, all of that.
It makes the customer's life easier. One throat to choke, so to speak, if something goes wrong.
But also, yeah, one validated design that's guaranteed to work. It's a powerful sales pitch.
Okay, that's a real bright spot. Now let's talk about the future tech that everyone gets excited about, the MISR DIMM. Multiplex rank DIMM. This is supposed to be the big bandwidth booster for AI servers.
The MISR DIMM is the shiny object on the horizon, for sure. But the earnings call provided a pretty serious reality check on the timeline.
Oh, really?
Yeah, the analysts were pressing hard on this. You could hear it in the Q&A. They were basically asking, when do we see the money from this?
And what did management say?
They poured a little cold water on the immediate hype. They clarified that any material revenue contribution from MISR DIMM won't happen until late 2026.
Late 2026, so Q4 at the earliest.
At the earliest, and the real volume ramp, the point where it actually starts moving the needle for a company this size, that's a 2027 story.
So if you are an investor buying Rambus today for the MS DIMM revolution, you are early.
You are very early, and there's a specific reason for this delay. It's not necessarily Rambus's fault either. It's a dependency issue.
Dependent on what?
MISR DIMMs required the next generation server platforms to function. We are talking about Intel's Diamond Rapids and AMD's Venice architectures.
The next big CPU cycles.
Exactly. Until those new server CPUs are shipping in volume, nobody needs an MSDIMM. It's a component for a system that doesn't exist yet in the mass market.
Right. You can't sell tires for a car that hasn't even rolled off the assembly line yet.
Perfect analogy. So while the tech is promising, and Rambus is clearly positioned for it, it is not a Q1 or Q2 2026 revenue rescuer. It's a 2027 growth lever.
Good to know. Let's briefly touch on the silicon IP business before we get back to the investor sentiment. This is the licensing side, the non-chip part of the business. How's that doing?
It's the steady Eddy. Performance was steady, with licensing billings at $71.5 million. Pretty much in line. But what's interesting here is the AI tailwind narrative they're building.
How so?
They're highlighting specific design wins in next-gen tech. Things like HBM4, that's high bandwidth memory for GPUs, DDR5 for graphics cards, and PCIe Gen 7 controllers for, super fast data transfer.
So this is the picks and shovels play for the custom silicon boom.
Precisely. Every hyperscaler, Google, Amazon, Microsoft, Meta, they're all building their own custom AI silicon, their own ASICs.
Right. They don't want to be totally dependent on NVIDIA.
And they don't want to design the complex memory controller or the I/O interface from scratch. It's too hard and time-consuming, so they license it from Rambus. So even if Rambus isn't selling a physical chip to them, their IP is inside the custom silicon that powers the AI cloud.
Okay, so to recap, we have a solid core RCD business that's taking share. We have a growing new product line in PMICs that's hitting double-digit contribution. We have a future option at MedRDIMMs for 2027. And a steady IP business catching the AI wave.
A lot of good things happening under the hood.
But we are stuck in this supply chain purgatory for Q1. And this brings us to the investor context segment. We need to analyze risks here.
And the biggest risk is the trust factor. It really is. In the semiconductor industry, reliability is everything.
What do you mean by that?
Well, put yourself in the shoes of Samsung or SK Hynix. You need 100,000 RCDs to build your server modules for a massive hyperscaler order from, say, Microsoft Azure. You cannot be late.
The penalties are huge.
Exactly. So if Rambus calls you and says, sorry, we have a quality hold on our parts, there's going to be a delay, do you just wait? Or do you pick up the phone and call their competitor like Renesas or Montage and say, hey, can you fill this order?
And management was adamant on the call. They claimed no reputational risk. They spun it as, we protected the customer by catching the error before it got to them.
Which is the correct PR spin. And to be fair, it's true. Catching a quality issue before it gets into a data center is infinitely better than having a massive recall later.
1,000 times better.
If a Rambus chip failed in a deployed server farm, that would be a catastrophe for them. So quarantining the stock was absolutely the right long-term move for the health of the business.
But the market is punishing the execution slip-up in the short term. It feels like this is a perfection-required environment for semis right now.
It absolutely is. The start price, that 14% drop, says the market is skeptical. The drop from 113 to 98 implies that investors fear some of that market share might have walked out the door during that glitch.
Even if it was just for a few weeks.
Even if you miss a shipment window in a tight supply market, your competitors will try to steal that slot. Now, management says they didn't lose anyone, but the proof will be in the Q2 numbers. That's when we'll know for sure.
Let's look at the macro read-throughs. What did this call tell us about the broader server market? Because Rambus is really a bellwether for memory and data center demand.
This was fascinating, actually. Rambus is taking a very conservative stance on growth. They are using a baseline of roughly 8% server unit growth for 2026.
8%. And where's that number from?
That's aligned with the big industry analysts, like Gartner. It's the standard safe number to use. But you've got bulls on the street calling for mid to high teens growth this year.
So Rambus might be sandbagging their market growth estimates a bit.
Or they're just being realistic about supply constraints. They explicitly stated on the call that the major constraint in 2026 will be supply, not demand.
That's a critical distinction.
It is. Lead times are lengthening across the board. Memory supply is tight. Substrates are tight. The whole industry can't build fast enough to meet the demand that's out there.
And if the market is supply constrained, it means the demand is robust, and it supports the pricing power thesis for everyone in the chain, including Rambus.
It does. And they made another important point about AI versus traditional servers. This was really interesting.
What was that?
For a while, everyone thought that AI servers, the big GPU clusters, would cannibalize traditional CPU servers.
Right.
That the pie wasn't growing, it was just shifting.
Right.
Rambus is seeing something different. They are seeing what they call agentic AI and inference workloads actually driving a refresh cycle for traditional CPU-based servers.
That is huge. So the need to run the AI models, not just train them, is creating new demand for the regular old servers.
Exactly, because you need those DIMM-heavy server architectures for inference. So if traditional servers are growing again, that is a massive tailwind for Rambus's core market.
It creates a dual engine for growth. You've got the AI training clusters using HBM, where Rambus plays in the IP.
And you've got the inference engines using standard DDR5, where Rambus sells the physical chips. It's a really bullish setup for the whole ecosystem.
Let's talk financial discipline for a moment. Even with a supply chain mess, did they sacrifice margins? Did they have to take a big write-down?
No. And that's a sign of a mature management team. They are sticking to their 61 to 63% gross margin range.
So they didn't panic and slash prices to move inventory?
No, and they said they don't expect big inventory write-downs because the inventory is just quarantined for retesting. It's not necessarily scrap, it's just delayed.
Okay, good.
Yeah.
And there was a nice little nugget on taxes I saw.
Yeah, a little sweetener for the model. The 2026 pro forma tax rate is dropping to roughly 16%, down from something in the low 20s.
And that's due to some legislation changes.
Yep. And that drops straight to the bottom line. It helps EPS, makes the valuation look a little bit better.
So here is the setup as I see it. We have sentiment arbitrage situation. Management is on the call, pounding the table, saying they're going to grow faster than the market in 2026. They see a V-shaped recovery.
A very confident tone from them.
The market, however, sees a broken quarter, a supply chain fumble, and they slash the stock price by 14%.
The disconnect is palpable. The opportunity, if there is one, lies in determining if that Q2 snapback is real. If it is, the stock is clearly mispriced right now. If the supply chain rot goes deeper, then the stock is a value trap.
And that brings us to our favorite segment of the show.
It's time.
We are going to switch gears. We're going to turn off the responsible journalist sign and turn on the hedge fund investment committee sign.
Okay, let's get into the war room.
Exactly. This is the part of the show where we look at the data we just discussed and we construct a trade. A high-risk, high-reward idea based only on what we heard on that call. This is not financial advice segment. All right, disclaimer time. This is absolutely not financial advice. We are two voices on a podcast. Do not trade your retirement savings based on this.
Please don't.
This is for entertainment and educational purposes only. Do your own diligence. Talk to a professional.
Okay, are we clear?
Crystal clear. Let's pitch.
Okay, I'm calling this pitch the supply chain rubber band trade.
The rubber band trade. I like the sound of that. Walk me through the setup. Here is the setup. The market has priced RMBS as if the Q1 revenue hole is permanent. They see a guide down to 172, 178 million, and they think, okay, Rambus has lost step, the growth story is broken, the stock is down 14%, trading around $98.
Right. The market abhors a vacuum, and right now there's a vacuum of confidence.
But look at the mechanics of what management said. They explicitly stated they pulled forward inventory to save Q4. That means the demand that was supposed to happen in Q1 didn't vanish into thin air. It just moved left on the timeline. It happened in December.
And the actual Q1 demand, the stuff they can't fill right now because of the quarantine?
When it gets pushed right into Q2. They said the customers are waiting.
So you were saying Q1 is artificially depressed and Q2 is going to be artificially inflated.
Exactly. It's a rubber band. You pulled it way back in Q1. In Q2, you not only let it go, but you have the force of the natural organic demand for Q2 PLUS, all the catch-up shipments from the inventory they are currently rescreening.
Okay. So the catalyst is the next earnings call, the Q1 earnings call, which will happen in, late April? Roughly 3 months from now.
Yes. On that call, they will report their Q1 numbers, which we already know will be soft. The market has priced that in. But then they will guide for Q2.
And that's the whole trade.
That's the whole trade. Think about the optics of that Q2 guide. If Q1 revenue is reported at that low 175 million level, but the Q2 guide comes in with all that catch-up revenue, the sequential quarter-over-quarter growth rate is going to look explosive.
It could be a 20 or even a 30% sequential jump from Q1 to Q2. It would be a massive number.
It will look like a rocket ship on the page.
Yeah.
And trading algorithms love massive sequential growth beats. You are betting on the optical illusion of a massive sequential growth print in Q2, re-rating the stocks multiple right back to pre-glitch levels.
So what's the trade structure? How do you play it?
You go long RMBS. Now, you could buy the equity if you want to be safer, just buy the stock at 98. But if you want the leverage, if you really want to play the bounce, you look at aggressive June calls.
Why June?
Because you need enough time to capture the Q1 earnings call in late April and the subsequent Q2 guidance.
Yeah.
June gives you a little bit of cushion for the market to digest the news and for the stock to move.
You're buying the dip with leverage, betting specifically on that guidance bounce, betting that by June, the whole narrative shifts from supply chain glitch back to record AI growth.
That's the thesis.
But we have to play devil's advocate. What is the kill box? How does this trade go to zero?
The kill box is simple, and it's twofold. One, the OSAT issue wasn't actually fixed. They get on the call in April and say, oh, we're still having some issues. That's a disaster.
Okay, that's the execution risk. What's the other part?
The other risk is even worse. While Rambus was offline for those few weeks rescreening parts, their big customers, SK Hynix or Samsung or Micron, didn't wait. They gave that market share slot to a competitor to keep their own production lines running.
So if that happened, the catch-up demand never materializes because it was already filled by someone else.
Exactly. If the Q2 guide comes out and it's just normal sequential growth instead of explosive, the rubber band snapped. The catch-up demand is gone and the trade is dead.
It's a binary bet on management's execution and their customer relationships.
A pure bet. But the risk reward, with the stock already down 14%, is certainly compelling for a trader with an iron stomach.
That is the supply chain rubber band. High risk, potentially high reward. Pure market psychology at play. Outro.
It is definitely a fascinating setup. When you boil it all down, Rambus is effectively a story of strong secular AI tailwinds. DDR5 data center growth interrupted by a transient but very painful manufacturing hiccup.
The fundamentals, as we discussed, they remain intact. The PMIC attach rate is climbing, which is great to see. The DDR5 transition is still in the middle innings. All the long-term drivers are there.
But the execution leash is now very, very short.
Well, what is? They used up their get-out-of-jail-free card with this Q1 guide. They have to deliver perfection in Q2. No more excuses.
So the question for you listening is this. Do you believe the V-shaped recovery story? Do you trust management that the glitch is truly gone and contained?
Or do you think the supply chain rot goes deeper? That maybe a competitor got a foot in the door while Rambus was distracted?
It's going to be a volatile few months for this stock, that's for sure.
Makes it interesting.
That's what makes it fun. Thanks for listening to this deep dive on Talk Tickers. We'll be watching the ticker. You should too.
See you on the next sprint.
Signing off.